So today we're going to dig into a fascinating crack in one of the absolute cornerstones of finance. The idea that market movements are basically random and, well, completely unpredictable.
All right, let's just jump right in. You've probably heard this a million times, right? The idea that you can't really beat the market because what a stock did yesterday has zero bearing on what it's going to do tomorrow. It's all just a coin flip. But what if that isn't the whole picture? What if there's a pattern, hiding in plain sight, that could turn that entire idea on its head?
You see, modern finance is built on this thing called the random walk hypothesis. And it's simple, really. It just says that tomorrow's price is a complete surprise. A stock that went up yesterday has no more reason to go up again than it does to go down. And for a long time, that idea made a lot of sense.
But then a few researchers, Moskowitz, O, and Peterson, found something, well, kind of mind-blowing. They discovered that for a whole bunch of different assets, their recent history wasn't random at all. In fact, how an asset did over the last year was actually a pretty darn good predictor of how it was going to do next month.
And this thing they uncovered? They called it time series momentum. Now, it's really important to get this straight. This is not the usual momentum that you might hear about on TV. This is a totally different beast.
So what is it really? In the simplest terms, time series momentum, let's call it TSMOM, is the idea that winners tend to keep winning and losers tend to keep losing, for a little while anyway. Think of it like a basketball player who's on fire and just can't miss a shot. TSMOM is basically a bet that the hot streak is going to continue.
Okay, and this is super important to understand. Most momentum strategies are what we call cross-sectional. They're all about comparing, say, Apple to Google to see which one is doing better. It's a relative game. But TSMOM is absolute. It looks at just one thing, say, crude oil, and asks a very simple question. Has its own price gone up or down over the last year? That's it. It's a judgment on its own performance, not a competition.
So, that's the theory. But you're probably thinking, does this actually work? Is it real? And this is where the story gets really, really good. Because this isn't some weird little quirk found in one tiny corner of the market. Oh no, this thing is everywhere.
The original study looked at 58 different things you could trade. And I'm not just talking about a few stocks here. We're talking about stock market indexes from different countries, government bonds, currencies like the yen and the euro, and a whole bunch of commodities. Everything from crude oil to soybeans to cocoa. And the trend worked on average for every single one of them.
But here's the catch. It's not like these trends go on forever. They have a life cycle. The research shows the effect is strongest for about a year. If something's been going up for 12 months, it's got a good chance of continuing. But after that, the magic starts to fade, and eventually the trend actually reverses a bit. And this totally lines up with theories about how we as humans react to news. First, we kind of underreact, letting a trend build up, and then we overreact, pushing it too far before it has to correct. And this right here just drives the point home. Look at this. A strategy built on TSMM didn't just work overall. It produced positive returns inside of every single major asset class they looked at. I mean, from crazy volatile commodities to supposedly boring old bonds, the pattern was there. That's what makes this so powerful and almost impossible to just brush aside.
All right, this all sounds great, but it brings up a huge question, right? In markets, for every winner, there has to be a loser. If this is a consistent way to make money, then somebody, somewhere, must be consistently losing it. So, who's footing the bill?
To figure this out, we have to look at who's playing the game. In these futures markets, you've basically got two camps. On one side, you've got speculators. Think hedge funds, traders, people who are trying to make a profit by betting on which way the price will go. Then on the other side, you've got hedgers. These are real businesses, like an airline that needs to buy jet fuel in the future and wants to lock in a price today. Or a farmer who wants to know for sure what price they'll get for their corn at harvest. They're not trying to make a buck on the market. They're trying to get rid of risk. And when the researchers dug into the data, what they found was just crystal clear. When a price started trending up, the speculators would pile in, buying more and more to ride the wave. And who was on the other side, selling to them? The hedgers. The speculators were trading with the trend, while the hedgers were systematically trading against it.
And that brings us right to the paper's big punchline conclusion. The profits from this weird market anomaly aren't just appearing out of nowhere. It's a transfer. It's money moving from the hedgers, who are basically willing to pay a small price for insurance, to the speculators, who are getting paid to provide that insurance.
Okay, so you might be thinking, cool, a clever trading strategy. But this is so much bigger than that. The very fact that this exists and the way it behaves poses a huge, profound puzzle for everything we thought we knew about how markets are supposed to work.
Let's start with the sheer performance. There's a metric in finance called the Sharpe ratio. The easiest way to think about it is bang for your buck. How much return are you getting for the amount of risk you're taking? Higher is always better. Well, the paper found that a TSMOM strategy had a Sharpe ratio more than twice as high as just buying and holding the stock market. That kind of performance is just unheard of. It's the kind of thing that financial models say shouldn't exist.
But here's where it gets really weird. You'd think a strategy with returns that good must be taking on some insane hidden risk, but it's the exact opposite. This strategy makes its most money during a crisis. Think about 2008. While everything was crashing, a trend follower would have been betting on prices to go down and making a fortune. It loves chaos. It does great in huge crashes and huge rallies. It's like having fire insurance that also pays out if your house doesn't burn down. And that kind of payoff profile is a massive headache for traditional risk-based theories.
And if you're not convinced yet, get this. This one simple idea, time series momentum, is so fundamental that it actually helps explain a bunch of other famous market puzzles, like that cross-sectional momentum we talked about earlier. It even explains a huge part of the profits of those super sophisticated hedge funds called managed futures funds. It seems like TSMOM isn't just an effect, it might be the core engine driving a lot of what we see in the markets.
So we're left with this incredible finding. A simple strategy that works across basically all markets, has amazing risk-adjusted returns, loves a good crisis, and seems to explain other big mysteries. It's a direct shot at the heart of the random walk theory. And it leaves us all with one pretty big question. If something this simple can be this powerful, what other unbreakable rules of finance are out there, just waiting for someone to come along and shatter them?